Index funds and actively managed funds represent two distinct investment approaches, each catering to different investor preferences and objectives. Index funds are passively managed, designed to track the performance of a specific market index, such as the S&P 500. They aim to replicate the index's returns by holding the same securities in the same proportions. As a result, index funds typically offer lower costs, greater transparency, and better tax efficiency due to minimal trading activity. While they do not attempt to outperform the market, their long-term performance often surpasses that of most actively managed funds because of their lower expenses and the inherent challenges of consistently beating the market. In contrast, actively managed funds are overseen by professional fund managers who actively make decisions about buying, selling, or holding assets. The goal of actively managed funds is to outperform the market or a benchmark index. However, this comes at a cost. Actively managed funds generally have higher management fees, trading costs, and less tax efficiency. Their performance heavily depends on the skill of the fund manager, and while they can potentially deliver superior returns, many actively managed funds fail to outperform their passive counterparts over the long term after accounting for fees. When it comes to risk, index funds tend to be less risky as they are broadly diversified and aim to match the market's performance. Actively managed funds, however, carry higher risk as they often focus on specific sectors or securities and depend on the manager's decisions. For investors, index funds are well suited for those seeking a low-cost, diversified, and straightforward investment approach. On the other hand, actively managed funds may appeal to those who are willing to accept higher costs and risks in exchange for the potential to outperform the market. In conclusion, index funds are generally a better choice for long-term, cost-conscious investors who value simplicity and predictability. Actively managed funds, while offering the potential for higher returns, are better suited for investors who trust a fund manager's expertise or seek specialized investment strategies. A combination of both could be beneficial, depending on individual financial goals and risk tolerance.